behalf. If they can only get a low interest rate return year on year for the next 5 years or so, that's going to mean they've got less to be able to hand back to you, and that is going to have an impact.
Many savers will be fearful too.
For the savings, it'll probably stay as they are. They won't go up any further than what they're going now. So it's really bad, the situation at the moment. I can't see a way out of it. They need to do something.
I have an ISA which I just throw money into long term. If it stays low, it's still making more money than not saving, isn't it? So I suppose you just have to ride it out and see how it goes.
But 4 years of record low interest rates would be mortgage holders' gain.
It's great news for me because I managed to overpay on my mortgage. When the interest rates dropped significantly, I just carried on paying at normal rate, so I paid off a little bit of my mortgage last year.
So if they stayed low,
I'd be really happy about that. If they go up, I could be struggling.
My mortgage is probably, I'm happy to say, about 25% of my total income a month. That's currently. If the mortgage rates go up, obviously my leisure time goes down because I've got less money to spend. If it stays low, then I might think about moving up the property ladder.
so having to keep on playing the waiting game would suit some down to the ground. But for many savers and pension holders, is it time for all change? Look for different products? It depends on who you think knows best about which way the economy is travelling.
Well, Claire Francis is from the online comparison website moneysupermarket.com and is with us now. Claire, welcome. We have many savers as well as borrowers watching Working Lunch. I think the thought of record low interest rates until at least 2014 will just leave them in despair. What do they think?
Absolutely. I mean, I think a lot of them have got a shock in the last few months because they've been getting their annual statements through, and obviously base rates now been on hold at 0.5% for over a year now. The good news is that the best savings rates are paying significantly more than the base rate. So base rate's 0.5%, but you can retain easy access to your money and still get between 2.5 and 2.8%, which obviously is a far cry from what you could get this time 2 years ago. But it's given that where base rate is, it's still a significant premium. And if you have money you can afford to lock away, you can earn higher than that. So 5-year fixed rate bonds, the highest rates on the market, are paying 4.9%. And if interest rates do stay where they are till 2014, then of course you're not taking too much of a risk there.
Oh, and you mentioned that rate, but what's the typical period you need to tie your money in for a bond, say?
Well, bonds are available from as little as 6 months right up to 5 years. So the key thing is that
the longer the bond,
the longer the term, the higher the rate. So 1-year rates are about 3.3% to 3.2% at the moment. So again, it's higher than you can get on easy access, but you can't get your money for 12 months, right up to 4.5% to 4.9% for 5 years.
So we're back to the age-old thing that if you want to make something out of your money, you have to make a bit of a sacrifice, either tie it up for a prolonged period of time or take bigger risks with it, which is what led so many people into the problems with investing in the Icelandic banks.
Yes, I mean, I think the key thing, since the Icelandic bank collapse, people have become much more aware of the security of their money. And as long as the institution you put it with is registered with the Financial Services Authority and the Financial Services Compensation Scheme, then up to £50,000 is totally protected, and it's £100,000 if the account's in joint names.
It makes me wonder, if interest rates are to stay low, the lenders or the banks and building societies, I would think, would try to encourage a bit more competition amongst each other and perhaps offer a few more better deals. Should savers hold out for things like that?
Well, I think the key thing for savers is to stay vigilant and be proactive, because a lot of people will have money sitting in accounts that are paying less than the base rate. So the key message for them is check what interest rate you're earning on your savings at the moment and move to one of these higher paying deals, even if it's an easy access account at sort of 2.5% to 2.8%, and just keep an eye on things. And again, if we see the market conditions changing, be prepared to move again.
Keep your options open.
So it's never enough just to put your money in an account and then leave it. You have to actively manage it all the time.
Especially if interest rates stay low for a prolonged period of time.
Turning this then on its head, looking at people who you'd think would benefit from lower interest rates, and that of course are the borrowers, of whom there are fewer than there are savers. What should they be doing? If your mortgage deal is coming to an end soon, should you think about locking in low rates now, or should you look at something else?
Well, I think over the last few months we've seen an increasing demand for fixed rate mortgages, because obviously people know that when the next move in interest rate comes, it will be upwards. And there'd been talk that we could see rates rising towards the end of the year or early next year. If they stay on hold now to 2014, then of course it makes tracker rates, which are variable rates, more attractive. But for some people, they'll always want the security of a fixed rate deal. And those, the great news for them is fixed rates are really low at the moment. If you look back historically, historically, you can fix your mortgage rate for 5 years at 3.99%. So the key is go for what's comfortable. If you can afford to take a bit of a risk and a bit of a gamble, you can get a lower rate with a tracker rate. But if you want that peace of mind and the security, then fixed rate deals do look attractive at the moment.
There's a lot to be said for security, I'm sure. What about people who want to retire? We did say we'd look at pensions. They want to buy an annuity when they retire. How hard are the annuity rates being hit by low interest rates?
Well, the problem for annuities is you only buy your annuity once, so it's not like other savings rates where you can move your money if the markets change. So obviously it's unfortunate for those in many ways who do need to buy annuities now because the rates have come down a lot. But having said that, there is still a massive variation between the best and the worst rates. And one of the things that people often get wrong is they think they have to buy their annuity from their pension provider, and that's not the case. So as is always the message with standard savings, shop around and find the best deal.
Claire, thank you very much for coming on. Claire Francis there from moneysupermarket.com.
Thank you.